What's up everyone, it's Karthik with MoneyVest, and we are going to be talking about CPI numbers that are going to be coming out in the upcoming week, as we know that CPI tends to be the third most volatile economic catalyst for the market. It's just next to non-farm payrolls, which is the jobs report, and the GDP numbers, which is the gross domestic productivity. CPI is a very, very volatile event in the markets because that's where the Federal Reserve gets a lot of data points to look at to further decide whether they're going to raise interest rates, cut interest rates, or keep them where they are. Since we are at the beginning of this rate cutting cycle, the markets are still very indecisive, I should say, uncertain about where rates are going to go. Are we going to see another 25, 50, or 75, or as much as 100 basis points worth of cuts in 2024? And the markets have now flipped back to just a 50 basis point rate cut in 2024, very much aligned with what the Federal Reserve is telling us as per their summary of economic projections. And this right here going into this upcoming week, where we're going to get the FOMC data, which is also going to be FOMC minutes, giving us a little bit more insight into what was discussed in the previous FOMC meeting, as well as inflation numbers, which I'll break down exactly when they're coming out and what their expectations are. The markets are pricing in for a 25 basis point cut to as much as another 25 basis points by December 2024, wrapping up the entire year with another 50 basis points, in totality about 100 basis points worth of cuts, and sitting at just about 4.25% and 4.5%. So that's what we have on the docket for the upcoming week. Make sure that you drop a like on this video, subscribe to the channel if you haven't already, and do check out our links down below with that 16% annual discount for the MoneyVest community tier. There's one more spot left if you're interested in joining, and 3 more spots left for the MoneyVest education tier, where you get access to all 4 courses, over 175 videos, as well as access to the MoneyVest website and the Discord access, options portfolios, all the trade alerts, our shopping list, our intrinsic values, our calculators. Everything's going to be available with the link down below, and we'd love to have you on board. If you have any questions, please feel free to reach out, and don't just take my analysis or opinions of the community. Just ask our other members, fellow members, existing members, and their experience, and I'm sure you're going to be satisfied with what we have to offer. So link's going to be down below. So this right here is the upcoming calendar for the different events that are coming up. Consumer credit is going to be the first thing at around 10/7, which is going to be Monday. We've also got the small business optimism report, so it's going to give us a little bit more insight into what small businesses are doing, what are the hiring and firing trends among small businesses, because believe it or not, it's really just small businesses that power the US economy. It's not the large cap, it's not the Magnificent Seven. A lot of their hires are overseas in other parts of the world, but it's really small local businesses that are doing a lot of employment work for the US. And if there's any type of trends suggesting that unemployment is indeed weakening, despite what we witnessed in the report from last week, so 4.2%, that's where we're coming down to, which is once again phenomenal. Unemployed persons coming down. That was actually a blockbuster report overall, suggesting that there is, after all, a very strong potential for that soft landing, which is why the markets ripped the way they hire on Friday. However, the small business report is still going to be very, very important, as well as the FOMC meeting minutes that are coming out on 10/9. So that's going to be on Wednesday at around 2 p.m. Eastern. And then, of course, we've got Thursday, which is 10/10. Very, very important numbers. That's going to be the CPI month over month, core CPI month over month, headline CPI year over year, and core CPI year over year. So these right here are the 4 very, very important events coming out, and expectations are for 0.1% month over month for headline CPI, core CPI to increase 0.2%, and year over year for us to be sitting at 2.3 on the headline CPI, and core sitting steady at 3.2%. So those right there are going to be some of the expectations. Now moving over to 10/11, that's going to be Friday. So Friday we've also got PPI numbers. So PPI numbers are going to be the producer price index that's also coming out. So PPI final month over month, ex PPI, ex food and energy, so it's core, as well as year over year numbers also scheduled to be released, and Michigan survey, Michigan sentiment, current conditions, inflation expectations on a 1-year and a 5 to 10 year basis also coming out as well, which the consensus is 2.7 to as much as 3%, which is again going to be a little bit higher than what the Fed's expectations are. And for producer price index for X food and energy, so core PPI year over year to accelerate from 2.4 to 2.7%. And then when you exclude for food energy on a year over year basis, and then we're looking at 1.6%, and month over month 0.1 to 0.2%. So those right there are going to be some of the inflation expectations. And like I said before in my previous update, so if you come over to the BLS website, a lot of people have essentially mentioned that a bigger risk for the US economy is not so much higher levels of inflation, it is more going to be towards stagflation, right? So if you come over to consumer price index here, you can pretty much look at the data on your own. So you come over to charts. This right here is the data that we're most interested in the last 20 years. And what you're really seeing here is that yes, inflation is trending lower, which is good. That's exactly what the Federal Reserve wants to see. Back in June of 2022, we were at well over 9%, and this number has been trending lower more recently from its highs of 3.5% down to 2.9, closer to whatever that number is, 2.5% as of August of 2024. However, it's really this, all items less food and energy, that the Federal Reserve is more concerned about. And what you are seeing is, yes, we are seeing some decent disinflation, meaning prices are coming down, but they're not coming down fast enough. And really, it's not about prices coming down. It's really about the rate of increase that's coming down. So prices overall for goods and services continues to go up. So I think that's a really important distinction that everyone needs to understand, that this is simply the rate of increase in the prices of goods and services. It's not the fact that prices are coming down on a year-over-year basis. It's just that the rate of increase is going down, right? So that's disinflation, it's not deflation. However, energy, which was for the longest time in deflation, so we kind of hit that deflation territory, back in sort of February and going into March 2023, gas prices at the pump were indeed lower on a year-over-year basis. Then we sort of kind of moved back higher to over 2.3, 3.7%, came back down in August of 24. However, I do believe that energy prices are actually going to be higher in the month of September and possibly in October as well. There's still hope that September might be a negative month for energy because we were lower in the month of September by over 7%. So prices at the pump, gas prices were still possibly lower, but October is definitely getting started on not the best footing because we're already up over 9% for oil prices due to the tensions over in the Middle East. So if that continues, we could easily see energy prices revert back to sort of that inflationary territory where prices are increasing on a year-over-year basis. And of course, we also want to see food continue to stabilize a little bit closer to 1.1%. So that's very solid. However, once again, the biggest wild card is going to be shelter prices as they are stabilizing a little bit higher. So the housing market continues to be more elevated, both in terms of asset prices and rents. At least owner's equivalent of rent that's being reported, 5.1% is that number, and we've only really come down from 8.2 down to 5.1%. So unless this number really starts to rotate lower, down to 2.5 or closer to 2 or possibly sub 2%, we're not really going to see inflation trending lower, especially not on the core side because shelter makes up for over a third of CPI. And when you exclude for food and energy, which again has been the factors that have been lowering inflation on a headline basis, but when you strip out food and energy, core CPI continues to be very elevated at well over 3.2%, right? So that's going to be pretty stable, pretty stagnant. So again, all items less food and energy, that's the number that's being quoted here, 3.2, that's pretty much been the number, and that's where we were going back as far as August of 2021. So yes, it's come down, but it's coming down at a very, very slow pace thanks to shelter prices and housing. Now, this right here, again, was the 0.2% witnessed back in August of 24. We've already gone over the interest rate expectations, but going over to the very important event. Now, we are just less than 30 days away from the big event in the US that's going to be elections. And we also saw Elon Musk at one of President Trump's rallies talking a lot about how people need to register to vote. And this right here is all election years going back as far as 1990 and volatility seasonality, which is exactly why I'm going to be ready with cash to deploy if there is any type of spike in the VIX pre-election. And also October seasonality, once the markets are up over 30% on a year-over-year basis on a 12-month period, going into fourth quarter doesn't tend to be so strong as if the markets were not up over 30% already in the last 12 months. I'll break that down in just a minute. But this right here is the volatility seasonality that everyone needs to be aware of. And this is markets seasonality, more specifically the small cap index selling off pre-election, and then of course seeing a very nice post-election rally going into November and December. Both of these indicators are essentially inverse to each other, and for the right reasons, because when the volatility does spike, we tend to see markets selling off and vice versa. Now this right here was also very, very interesting, which essentially suggested that hedge funds are now the least bullish on Magnificent Seven stocks since May 2023. So this index has been coming down. So this is the prime book percentage of total US net exposure on Magnificent 7, and this number has been coming down from highs of about 20 to 22%, which is where it's sitting now at closer to around 16% at the moment. So this is where we are. This is coming down in terms of exposure, in terms of that risk on environment. And once again, that's because of the uncertainty around elections. And this is another really interesting chart suggesting for the risk appetite, which is now at an 11-month low. Once again, this is the percentage of fund managers taking higher than normal risk levels in investment strategy and portfolios. So this goes back to our discussion from our market updates, where just the market positioning overall and the fact that technology has been such a laggard in this entire 2024 year just goes to show that markets are very defensive. And you can see that in the money market funds that are sitting on the sidelines, risk appetite, which is at its lowest levels in over 11 months, and the exposure of hedge funds in Magnificent stock coming down to its lowest level since May 23. So it's well over 12, 14, I think 16 months, if my math is correct, that we're coming down to in this lowest exposure of 16%. So utilities leading the market higher, almost 29%, comm services 25%, financials up 21%, then we have industrials up 20%, and then comes technology with a 18% gain. So it's not having a terrible year, but yes, it is definitely lagging behind by a full 10 percentage points relative to utilities, which is definitely a very defensive positioning in this market. Now, of course, post-election, I do expect things to kind of shift a little bit depending on who's going to be in the office. I do expect a post-election, some strength in the economy and the markets if, of course, we continue to see inflation trending downwards, economic conditions to stay strong with a very strong labor market, and interest rate cuts continue to come in. That's going to once again put that soft landing scenario very much back on the table. And the S&P 500 is up nearly 35% in the last 12 months. This was from Ryan Detrick on X, and this is one of the best 12-month rallies ever going into fourth quarter. And worth noting that October higher only once out of the 6 times it was up 30% or more going into Q4, and Q4 below average returns as well. So October return, the only time it was higher was back in 1975. So October on an average and a median basis was lower, 4.3 to 2.5% on an average and median basis. Only 16% of the times it was higher. So what this analysis is really telling us that once the markets are going into fourth quarter, after being up over 30% in the last 12 months, the fourth quarter, and more specifically the October return, has only been up 16% of the times. And this analysis is going back as far as 1950. So I think that's a lot of data sets going back to better understand the potential for the markets to have a stronger October. And I'm not saying that this is going to play out exactly like this. We're going to be down by on average or median 4 to 2%. But I think it's a good data set for us to expect probabilistically, right? I don't know if that's a word, but based on probability and based on historical data, we can kind of figure out, okay, be ready with cash if the MoneyVest index does drop, if the volatility does spike, if there is pre-election volatility in the markets, and we can get those buying opportunities. Look what happens in the fourth quarter, right? Going into November and December, the probability is much higher, 66.7%, right? 2/3 of the time we've been higher in the fourth quarter by an average and median gain of 0.3 to as much as 3.3%. So definitely very, very strong recoveries after the September-October sell-off in the market. And I think we get a very similar analysis from Tom Lee at FundStrat as well. October iffy, November looks good. That was the analysis from the previous video that I also shared with everyone. And this right here is Yardeni Research and S&P 500's forward price earnings multiple. Right now we're sitting at just a little bit over 21. And these are some of the bands, which is what we had discussed in our previous updates as well. Where is the actual price earnings multiple? And we're kind of coming back up to some of the levels witnessed back in 2022, right before the start of that bear market. So from a valuation perspective, yes, it's not cheap, but it's also not super expensive. It's kind of like in that zone where I'm not a buyer, but I'm also not selling stocks at the same time. And earnings do matter. If anybody tells you earnings don't matter, earnings is what drives the market higher over the long term. If earnings are growing, that's why markets are growing, because markets are just a multiple of earnings at the end of the day. It's nothing else. It's literally just a multiple of bottom line profit. And if the profits are expanding, their margins are growing, and earnings are growing bottom line, then that's why markets are going to expand and of course grow further. So this right here is a very good example of how everything sort of falls together, increases together. We see earnings and the markets themselves kind of go down at the same time, and of course recover at the same time as well. And this right here is again earnings with CPI. That's the CPI inflation rate as well as the earnings. And you'll notice that they also once again spike together, go down together, kind of move in tandem with each other. And this is where the MoneyVest index finally sits as of Friday's update as well. No really changes. 3.91 is where we are with the volatility reading at just a little bit under 19. So keep in mind that we're kind of heading into a time of the year where there is going to be some level of volatility with the uncertainty around election years, seasonality. We got the CPI report coming out next week, and of course interest rate expectations so vulnerable to economic data that they're going to be shifting around quite a bit as we head into the next FOMC meeting happening on my birthday, November 7th. 2024. So hope you all enjoyed this video, found it helpful. If you did, make sure that you drop a like on MoneyVest, at MoneyVest here in our community. We're going to keep things very, very simple. We're going to cut out all the noise. We're going to follow our MoneyVest dashboard to better understand when there is buying opportunities, when the risk reward is going to be very, very solid for us to deploy capital to dollar cost average into the market. And that's what I've been following for a long time, and it's been very, very successful. Don't ask me, ask our members. Join our community with that 16% annual discount if you're interested. And let's get ready for the very important inflation numbers coming out next week. Happy investing. I'll see you all in the next video.